Hello friends, thank you for your time. In our last video, we saw about bar chart pattern. Today we are going to see about strategies. Why we are seeing about strategies? Because the first step in making profit or making any trade is to have a strategy, isn't it? First we need to have some strategy, right? Today we are going to discuss about tons and tons of strategies. What are those strategies? How can we group those strategies? Buckle your seatbelt. Let's have an extreme ride. And do not forget, all the information that I'm going to share in a detailed manner and as well as in a crisp manner. I captured it in notes. The note link is available right in the description box. Do not forget to download and make use of it. Come on, without much delay, let's hop into our session. What is our session? Short-term patterns. Short-term patterns. Come on, guys. Short-term pattern appear in bar charts and in candlestick chart. Short-term pattern concentrate on the bar height and the position of open and close of the bar. Some patterns compare the current bar with preceding bars. Why we use the term short-term pattern? Short-term pattern uses fewer bars, couple of bars. Short-term pattern occurs more frequently. Why? Because the input for the short-term pattern is high, low, open and close. The data that is contributing the short-term pattern is simple. If the data contributing the short-term pattern or creation of the short-term pattern is simple, the frequency of the short-term pattern is more. If it is otherwise, the frequency will be lesser. These short-term patterns not only used for trading strategies, they also used to improve the profitability in case of long-term position by appropriately entering and exiting the position. In the previous video, we saw about long-term patterns, right? Similar to that, we have breakouts in long-term patterns, triangles, rectangles, head and shoulders. Similar to that, we have the breakout for short-term pattern as well, which we'll be discussing in detail. So, prior trend should be known before we trade using short-term pattern. Why? Top pattern in downward market is of no use. Bottom pattern is to be used in downward market. Short-term reversal patterns are of more use when it happens near to support and resistance levels. These patterns, support, resistance, trend line are all evidences. With these evidences, we'll take our trades. When there is a group of evidence that supports us to initiate a trade, which is called cluster of evidence. These patterns also help us to identify the momentum, upward momentum, downward momentum. When the momentum is slowing or if the momentum is increasing, we can identify that using these patterns. These are not only reversal pattern, this can also be a continuation pattern in correction with the trend. As per the book, what is the secret of success? Experience and recording our success and failure, documenting our success and failure. Why do we need to document success and failure? Because in case, if needed, we can refer that in the future. Same applies for pattern as well. Now we are going to discuss about traditional short-term patterns. One of the traditional short-term pattern is gaps. What is a gap? Let us see with this example. If the high for the current bar is lower than the low for the previous bar, it is a gap. Other name for gaps are hole or void because price range at which no shares change hands. Similarly, when the low for the current bar is above the high for the previous bar, that is also a gap. It is basically these gaps are beginning of a new trend. We are going to discuss about different kinds of gap. One such gap is breakaway gap or breakout gap. It's a profitable gap. We'll see with an example. It basically occurs at the beginning of a trend. Occurs when price suddenly break through a formation boundary and a major change in trend direction begins. It signals that a pattern is completed and a boundary penetrated. The size of the gap appears to be proportional to the strength of the subsequent price move. More the size, more the strength. Gap happens in either direction. Upward gap, downward gap. Gap may be supported with heavy volume. Downward gap not necessary to have heavy volume. Trading setup, wait for a short while for the profit taking by professional to see the gap is filled. If not, enter in the direction of the gap. In this picture, there is a gap and we'll wait for some time and we'll enter in the direction of the gap. We'll place an entry buy stop. What is entry buy stop? We'll place a stop order. When the stop is triggered, we'll buy the position, we'll buy the stock or whatever it is. Where should we place the exit stop? At a point where the gap will be filled. If the gap is getting filled, if it is going in a reverse direction, instead of going upward move in this example, we'll place a protective stop here. If the gap is filled immediately, a stop and reverse might be appropriate because a sudden failure in a gap is often followed by a large move in the opposite direction from the gap direction. Opening gap, if the price of current day opens beyond the range of yesterday, then it is a opening gap. There is upward opening gap and downward opening gap. Upward opening gap often gets filled. Downward opening gap, lesser chance of getting filled. A fill is a sign of weakness. Normally, it never happens in breakaway gap. If the gap is not filled in the initial half hour, the probability of trend continuing in the direction of the gap is more. This is previous day low. Price opened for the current day right here. There is a gap. However, after some time, the gap got filled up. This is an opening gap and later part of the day, the gap filled up. We already seen breakaway gap. The next gap is runaway gap. We covered breakaway gap and opening gap. Now it is runaway gap. Runaway gap happens alongside the trend. Runaway gap is a confirmation that the trend is still active. Runaway gap is similar to flags and pennants. Like we can have a measurement of flags and pennants target setting, right? Similar to that, we can measure from the trend start till runaway as a measurement, and we can add that measurement to the runaway gap, and that will be the target for the security. Because of that, this runaway gap as well called as measuring gap. Another kind of gap is exhaustion gap. Exhaustion gap mostly happens at the end of the trend, but we may not realize it as an exhaustion gap till the exhaustion gap is closed. We may believe the exhaustion gap is similar to a runaway gap. Only after the close of the gap, we can realize that this is an exhaustion gap. What is a sign to recognize an exhaustion gap? The gap gets filled up. Another gap, common gap. Common gap normally happens in illiquid securities. It even appears in short-term trading. There are no consequences for common gap. Pattern gaps appear within the formation of larger patterns and generally they are filled. Their only significance is to suggest that a congestion area is forming. Ex-dividend gaps occur in stock prices when a dividend is paid and the stock price is adjusted the following day. There is no significance for this ex-dividend gaps. Suspension gaps occur in 24-hour futures trading when one market closes and another opens, especially if one market is electronic and the other open outright. No much significance for this suspension gaps as well. Please be aware. First one we are going to discuss is a spike. Another name for spike is wide range or large range bar. Spike is similar to a gap. However, it happened during the trading day. Gap happened during off hour, but spikes happen during the trading day. Spikes can occur as a formation, as a breakout. Spikes can be midpoint in a strong accelerating trend. Spikes can also be final reversal day at the end of the trend. At the end of an accelerated trend, the last bar within the trend is often a spike called a climax. Spikes can represent the beginning or end of the trend. Next one we are going to see is dead cat bounce. Name is little peculiar, but this is the name we have, dead cat bounce. How can we identify dead cat bounce? After a large downward breakaway gap, you can see breakaway gap after a large downward breakaway gap, or it can also be a spike. In the previously we seen spike is also similar to gap. So here as a definition, the identification can be done if it happens after a large breakaway gap or a downward breakaway spike. What is the characteristics of DCB, dead cat bounce? There is a short rally of several days up to 2 weeks following the initial bottom from the sharp initial news event sell off. There is a short rally. There is a breakaway gap and there is a short rally. The rally should follow an event decline of more than 20%. The larger the first decline, the higher the bounce. Larger the first decline, higher the bounce. Buyers are usually wrong. The price continued to lower after the DCB. This is not the reversing trend. The downward movement continues after DCB. The second decline in DCB is characteristically less intense, accompanied by much lower volume. This is the second decline. Much lower volume expected. Island reversal occurs at either top or bottom and only after a relatively lengthy trend. It happens almost at the end of the trend. Let us see this bearish example. Bullish is actually the opposite for bearish. First, there is an exhaustion gap in the direction of the trend. This is the exhaustion gap. Second, in the reverse direction, a breakaway gap. This is the breakaway gap. Extreme price in the island must be either higher than previous high at the top. Right now we are discussing about the top pattern, or lower than previous low at the bottom. This should be the highest high in this bearish formation. Larger the gap, these gaps, larger the gap, the more important is a formation. Between the gaps, low volatility trading expected. Volume increases on the second gap from an island top, but not necessarily from a bottom. Now we are going to discuss about 1 and 2 bar reversal pattern. The first one is 1 bar reversal. If you focus in this bar, the high of this bar is higher than the previous high and the close is below the previous close. Now this is considered as a reversal and the bullish trend is now a bearish trend. Instead of close below the previous close, we can also filter it by having a condition like close below the previous low or close below previous two lows. Just a variation. It is completely negated once price exceeds its reversal peak. This is bearish 1 bar reversal. The opposite is true for bullish 1 bar reversal. Next one is 2 bar reversal. The other name for 2 bar reversal is pipe formation. In 2 bar reversal, it is similar to 1 bar reversal, but instead of having 1 bar, the same happen across 2 different bars. In the first bar, usually closes in the lower half of the bar, indicating a bearish bar, and the second bar closes near its high, indicating a bullish bar. This is a bottom bar pattern. Top bar pattern is the reverse. Second bar should be slightly longer than the first bar. If this formation happen, considered as end of the trend and trend reverses. Third one is horn pattern. Similar to 2 bar reversal. However, there is a small bar in between 2 bars. This formation is more reliable with weekly bars and has the same characteristics as the pipe. In 2 bar breakout, today's low is less than previous day's low. Today's high is less than previous day's high. Today's close is less than open. In that situation, in the current bar, buy on a stop 1 tick above previous bar's high. 1 tick above previous bar's high. Exit on a stop at the previous day's low. This is for buy side. For sell side, it's a just opposite. Inside bar. An inside bar is a bar with a range that is smaller than the previous bar range, which is similar to Harami candlestick pattern which we'll be discussing shortly. Bullish inside bar happens after a decline. The first bar is a tall bar and the closing is below the open price. Second bar is within the range of the first bar, having a closing price more than the open price. This is considered as bullish. Bearish is exactly opposite. When this happens, the expectation is trend reversed. Hook reversal day. Hook reversal occurs after a series of upward thrust bars called run bars. Then suddenly a narrow range bar occurs with specific characteristics. Inside bar that opens at its high and closes at its low. This signals that the momentum built up during the run has reached a climax and the trend reverses. What we discussed is for uptrend and the opposite is true for downtrend. Naked bar upward reversal. Naked bar is one that closes below a previous low and is a down bar. What is a down bar? Closes less than the open. If an inside bar follows a naked bar with open greater than the naked bar close, it is a sign that downtrend is reversing. An upward break from the inside bar would suggest the bears are caught. Hikake, another name is trap or trick. This pattern starts with the inside bar. When price break one way or the other from inside bar, the conventional belief is that they will continue in the same direction. The Hikake pattern occurs when the breakout fails to continue and price in the following bar return to break in the opposite direction through the previous inside bar extreme. The reversal and opposite breakout must occur within 3 bars after the first breakout. The open and close of each bar seems to be unimportant. Right at the third bar, when it breaks the low of the inside bar, traders place a sell order because failure happened right at this level. Opposite is true for buy order. Outside bar and other multiple bar patterns. Outside bar. Outside bar is a bar with a range that is larger than the previous bar range, which is similar to engulfing candlestick pattern, which we are going to see shortly. Bullish outside bar takes place after a decline. The first bar is a small bar and the closing price is below the opening price. And the second bar, a tall bar that has closing price more than the opening price. The trend is expected to be reverse. Bearish outside bar is the opposite for bullish outside bar. Knockout pattern. Extremely strong and persistent trend must be present. Strong uptrend. Stock must have risen at least 10 points in the past 20 trading days. And a trend line drawn through the prices touches almost all bars. At some time, the stock will develop a throwback of 2 to 5 days in which 2 prior lows will be exceeded. Place a buy entry stop at the high of the bar with the second low. If the next bar is lower, move the buy stop to its high until the position is executed. Place a protective stop below the last low or use any reasonable stop method. This is oops pattern. Opening price on today's bar is outside the previous day's range. Stock opens today at price below yesterday's range. A buy stop is then placed just inside yesterday's range or first day's low in case the market closes the gap, indicating a reversal. Sell stop near the second day's opening. Shark pattern. Shark is a 3-bar pattern. Most recent bar is an inside bar. The previous bar must also be an inside bar. The progression in bars therefore is 1 base bar and 2 successive inside bars. In effect, it is a small triangle or pennant. Buy on the close of the first day after a day in which the close exceeded the widest point in the pattern, usually the base day. Trailing stop or reversal on the opposite signal. There are few more patterns. I just captured it in the notes. Notes, you can download it right from the description box. Please download and review based on your convenience. Till now, we discuss about short-term patterns in bar charts. Now we are going to discuss about candlestick patterns. Raw data used in candlestick chart is the same as the raw data used in bar chart. What are those raw data? There are four raw information needed for candlestick pattern. Open, close, high and low price per specific period. If we are using for day period, then it's day, open, close, high, low. If we are using for hourly period, then it is hour, specific, open, close, high and low. Why candlestick chart is popular? Because it represents price action in a more striking way, and patterns that result have interesting and novel names, appealing ones. Candlestick can still use the Western method of analysis. Even for candlestick chart, we can use the same patterns we discussed in the previous video, trend line, support and resistance. It has a set of unique patterns of its own we are going to discuss shortly. These patterns are mostly short term of only 1 to 5 bars. This is mostly reversal patterns and can reveal price reversals early in overbought or oversold conditions, or at trend lines, or at support or resistance level. They are tools. They're just a tool, not a system by itself. The disadvantage of candlestick pattern is that one must wait for the close before a pattern can be recognized, and they are useless in the market that do not accurately report the opening prices. There are some markets where opening prices are not accurately reported. In those situations, candlestick pattern are of no use. Patterns are made by the relative position of the body and the shadow, the location of the candlestick in relation to the neighbors, and the confirmation the next day. We are going to see all these examples shortly. Pattern should always be used with other evidence. We need cluster of evidence. What is cluster of evidence? Like support, resistance, trend line, etc. Measuring the effectiveness of patterns over weeks or months is useless because these patterns are only useful in short-term situations. Let us see a few of the candlestick pattern. The first one is doji. The formation open and close are identical or nearly identical. This is the open, this is the close. It looks like a plus mark. Sometimes there will be little difference between open and close. It need not to be always exactly same. Little smaller tick difference should be fine. What is the meaning of it? The market is in equilibrium, indecision. It's neither taking buy position nor taking sell position. It's like an inside bar. What is the meaning of this doji? It's a warning of reversal, but it is not a reversal by itself. We need to wait for the next candle to take a decision. Doji. Harami. Harami. What is harami? The harami formation is like this. This is the top harami formation and this is the bottom harami formation. Second candlestick in this pattern is called spinning top. Spinning top. Second candlestick can also be a doji, hammer, hanging man or shooting star. What is hammer, hanging man or shooting star? We'll be discussing shortly. Only requirement is that second candle body is within the first candle body. This is the body of the candle. As I mentioned, only requirement is that second candlestick body. This is the body. Black one is the body. And solid white is also a body. The black body should be within the white body, or white body should be within the black body. The range or wick of the second bar does not have to be within the range of the first bar. Only body should be within the previous body. Wick or shadow need not to be within the previous range. This is similar to inside bar pattern we discussed in the bar chart. Next one is hammer and hanging man. Hanging man, when this formation happen at the top of the trend, this is called as hanging man. And if this happen at the bottom of the trend, then it is called hammer. Either can be black or white. Both in the top or the bottom, color doesn't make any difference. Lower wick or lower shadow is at least twice to 3 times as long as the body. Upper wick is small or non-existent. There can be a small wick in the top or it can be non-existent as well. Both open and close occur within approximately the top 1/3 of the bar's trading range. Open and close. Open or close is or nearly is the highest price of the bar. In this case, open is the highest price. In this case, close is the highest price. Color of the body is irrelevant, which I already explained. Shooting star and inverted hammer. It's similar to hanging and hammer and hanging man formation, but it is the reverse, opposite. If this kind of formation happens in the top, we'll call it as shooting star. If this kind of formation happen in the bottom, we call it as inverted hammer. Either case, color doesn't matter. Either can be black or white. Top can be black or white. Bottom can also be black or white. Real body occurs in the lower end of the trading range. Real body. Long shadow above their bodies and short or non-existent shadows below their bodies. Long shadow above their bodies. In the bottom, there can be small shadow or sometimes non-existent as well. Next pattern we are going to see is engulfing. The pattern formation is like first we have a small range candle or the body of the first candle is small and the second candle is bigger than the second candle's body is bigger than the first candle's body. It engulfs. So the name engulfing will have. Right? This is the top engulfing formation and this is the bottom engulfing formation. This is similar to outside day reversal. We've seen outside day reversal in the bar chart patterns, right? This is similar to outside day reversal. If this formation happen in the uptrend market, then this indicates it's a market top. We are about to reverse and market is supposed to go downward. Stronger signal when first body is small and the second body is large. Dark cloud cover and piercing line. This is the top formation. We call it as dark cloud cover. This is the bottom formation, which we name it as piercing line. The formation happens like this. The second candle open is above the high of the first candle. Basically, it's an opening gap. Then the second candle closes well within the first bar's white body, preferably below 50% level. This is similar to OOPS pattern we discussed in bar chart patterns. Pattern is enhanced by a deeper penetration of the white body or black body. In the top formation, if the black body is having deeper penetration, pattern is enhanced. In the bottom formation, the white candle penetrates deep into the black body. Morning and evening star, these are three candle formation. The body of the star lies completely below the body of the previous candle, or above the body of previous candle. The pattern is then confirmed if on the third bar, a white bodied candle close well within the range of the first candle. In bottom, it will be white body. In the top, it will be black body. Second candle lies outside the range of the body before it. Second candle body does not overlap the previous bar's body at all. Amount of penetration into the first body is more important. More the penetration, more significant the formation is. The next multiple candle pattern we are going to discuss is 3 black crows and 3 white soldiers. 3 consecutive, preferably long black bodies, or 3 consecutive, preferably long white bodies. Close near their lows with opening within the previous day's body. Opening is right here. Close is near the lows. Occurring after a meaningful uptrend or downtrend. This is top reversal formation. This is bottom reversal formation. This is difficult profiting because by the time they are recognized, a large portion of the new trend has already occurred. They are best played on a pullback or throwback. The last 2 patterns, multiple candlestick patterns, 3 inside up, 3 inside down. This is similar to a breakout from an inside bar in bar chart pattern. The formation is there is a inside narrow candle created and there is a breakout. Inside narrow candle created and there is a breakout upward. This is the top formation and this is the bottom formation. 3 outside up, 3 outside down. First we have a wider bar. First we have a narrow bar. Then the second is like an engulfing. And the third one is a breakout. Narrow bar, engulfing bar, and breakout. This is less predictable and less profitable than inside bar because volatility has already expanded and is open to contraction at any time soon. The result of this pattern show decreased performance. Oh, what a ride. Tons and tons of patterns, right? Thank you for sticking till the end of this video. Short-term patterns, now you are aware, it happens in bar chart, it happens in candlestick chart. Short-term pattern is a reversal pattern, isn't it? We've seen till now, right? The reversal pattern help to identify the start of the trend and help to identify the end of the trend. We need to identify the start of the trend as early as possible so that we can hop in as early as possible. We need to identify the end of the trend so that we can get out of the trend as quick as possible. And another thing we need to consider in case of short-term pattern is short-term pattern by itself may or may not give any indication. We need cluster of evidence. What is cluster of evidence? Support and resistance, trend, and the short-term pattern will help us to identify the trend reversals. So as given in the book, what is the secret of success? Experience and practice. Not only experience and practice, continuous learning. So that's why I try to compress one of the bigger chapter into short video like this. Please spend some time, watch this video and record your success and failure. Document your success and failure because in case of failure in the future, it will be helpful or handy for you to refer your documentation. Thank you friends. Thank you for your time. Consider subscribing to my channel. All the information that I discussed, I captured in the notes. Notes you can download from the description box. See you in the next video. Bye bye.